Hi, and welcome to the Day Trading for Beginners podcast. This is episode 30. And in this episode, we're talking about Elliott Wave Theory. So this is going to be very much an introduction to Elliott Wave Theory. It's quite a big topic. So here we just want to learn a little bit about it and maybe spark some interest where you might want to go out and learn more about this particular trading concept. So, if you've been following along right now, we're on a journey to become a full-time day trader. We are sort of in month 5 right now, and we are studying technical analysis. We've covered quite a few things along this journey, and some of them, you might relate to a little bit more. You might be more interested in than others. For me personally, I'm sort of leaning towards maybe, looking more into Elliott Wave Theory and potentially using this in my strategy. So at this stage of the journey, I don't really have a strategy yet. I plan to study one in the next sort of phase of this journey. But after coming across Elliott Wave Theory and some resources that I'm going to actually share with you in this podcast and in the show notes, I'm sort of interested in this. I'm leaning more towards it. I kind of like it as opposed to, maybe some other techniques and tools or concepts that, might be less interesting. So for me, the Forex market is something I'm not really into. Options, I personally do like the idea of options. Many people, don't really want to trade options, and you don't have to. You might learn a bit about Elliott Wave Theory and think, I don't want to use that at all. Or you might, be interested in it like I am. So there's many things, when you kind of look more into this, people are going to have various strategies, and they're going to use certain tools while others won't use these tools at all. So, there's certain people that trade the markets, they don't use the indicators like the MACD or the RSI, while others, rely on that heavily for their strategy. And the same goes with Elliott Wave Theory. Certain traders might be familiar with it, and they might use a little bit of it to, just confirm some of their trades, while others are going to rely on it entirely for their whole strategy. So that's kind of what I have noticed after, diving in and studying a little bit about the various concepts and techniques in technical analysis. So again, for me, I think I'm going to pursue this more in the future. And one of the reasons why is that I've come across some good resources, and there's someone on X who I've been following, and I'm going to link the resources below in the show notes. But basically, this person called the Tesla Tracker, they have a live stream every day on X where they day trade Tesla and various other stocks as well. And they use Elliott Wave Theory. And it's just something that I've liked following along with. And I'm starting to understand it a bit better. And I kind of just like the strategy. So again, in the show notes, you can go find their account. You can check out some of their past videos. And every day, this person does a live stream when the market opens, and he talks all about Tesla and talks about other stocks as well. And he has the charts up there, and he sort of explains how he trades with Elliott Wave Theory. So I think those resources are useful, and I'm going to include them below in the show notes. So let's jump right into it. Elliott Wave Theory. And again, this is going to be very much an introduction because this is quite a big topic, and it can get a little complicated, especially when you're just hearing a audio sort of format here. But if you think about it, as a beginner, to the untrained eye, the ebbs and flows of the market, they can seem really random and chaotic. And, before you studied any of this, you might have thought everything was sort of random and chaotic. But now that you're understanding a little bit more, you can kind of see some patterns. Well, imagine, you could sort of decode these patterns, and you can use them to predict future market movements with greater accuracy. Well, that's sort of what Elliott Wave Theory can offer. A structured approach to understanding and forecasting market trends based on what are called well-defined wave patterns. So in this podcast, we're going to just get introduced to Elliott Wave Theory. We're going to discuss the basics of identifying these waves. They're called impulse and corrective waves. And then we're going to also talk about these Fibonacci tools that are used in the whole context of Elliott Wave Theory. So by the end, again, I'm hoping you just have sort of a foundational maybe understanding. And then if this is something that interests you, then I would recommend that you check out the other resources and potentially learn more about this Elliott Wave Theory. So Below, I'll have a link to the Tesla tracker on X. Again, he's great, someone to follow and learn more about if you're interested in Elliott Wave Theory. And then I have a link to a slideshow presentation that's really useful that can go hand in hand with this podcast. And then there's a website called ElliottWaveTrader.net, which is very useful as well. And those two resources are actually recommended by the Tesla tracker on X. So that's how I found them. So the basics of this Elliott Wave Theory, basically, it's a popular method of technical analysis. And like every other sort of tool, you use it to make price predictions. So it was developed by someone called Ralph Nelson Elliott back in the 1930s. And it's based really on this idea that market prices move in predictable patterns due to investor psychology. So, that plays a big role in a lot of the things that we're doing, this whole psychology of the market. And what Elliott Wave Theory suggests is that financial markets, they move in a series of waves, which can be divided into two types. So you have what are called impulse waves, and these move in the direction of the overall trend, and they consist of 5 smaller waves. And then you have corrective waves, and these these waves move against the overall trend that is currently going on, and they consist of 3 smaller waves. So the entire sort of market cycle, it's made up of 8 waves. You got 5 impulse waves up, followed by 3 corrective waves down. Now, it does get a little bit more complicated because each one of those waves has 5 waves and 3 waves down. So when you kind of hear this or you see it for the first time, you're thinking, there's so many of these waves and movements. But once you sort of, listen to this podcast, read a few articles, watch a few videos, it's going to start to sink in. But basically, you've got impulse waves. So there are 5 of them up, and then you've got corrective waves, and that are 3 down. And then again, within those waves, you got to remember the stock price and the stock market, it's moving up in zigzags all the time. So there's actually more within, these basic foundational waves, if you will. So wave 1, basically, that's like the market starts to move in the direction of a new trend. So usually when you recognize this first wave, it's because you're starting off a new trend, and recognizing that first one seems to be quite important. And then the second wave, so you move up towards wave 1, and then wave 2, the market pulls back, but it doesn't retrace all the way back to wave 1. So it's basically you're moving up to wave 1, and then you come back down, and coming back down, that first little correction wave, that is wave 2. And then you have wave 3, where this is like the strongest and the longest wave in the whole move. And that moves up significantly to the direction of the trend. And then wave 4 is another pullback, but it's not as severe as wave 2. And then wave 5 is like the final move. And again, within those 5 waves, you'll have 5 smaller waves and 3 smaller corrective waves as well. So those waves and those patterns, they are sort of connected to these things called the Fibonacci numbers. So when combined with the Fibonacci numbers, Elliott Wave Theory, it can be a very powerful tool for making trading decisions. Okay, so what are these Fibonacci numbers? If you've been watching any trading that's been going on, you might hear people say the short form is like the fib. So, the stock might retrace down to the certain fib number, or it might extend up to a certain fib number. And basically, Fibonacci, he was this Italian mathematician born around 1170, and he introduced sort of the Fibonacci sequence of numbers to sort of Western mathematics. So Elliott Wave Theory and these Fibonacci numbers, they're intertwined because the wave patterns that are identified by this Elliott Wave Theory, they sort of follow this Fibonacci sequence. So the Fibonacci sequence, you can kind of go and learn more about it. Here we're going to just cover it very sort of briefly, and again, just sort of a introduction to this. But basically, this sequence, it begins with 0 and 1, and each subsequent number is the sum of the previous two. So the sequence goes 0, 1, 1, 2, 3, 5, 8, 13, 21, and etc. So if you have 8, basically that is because you did 3 plus 5, and then to get 13, you would do 5 plus 8, and then to get 21, you do 8 plus 13. And basically that's how the sequence goes. And this sequence gives rise to several important ratios used in predicting market movement. So there's the ratio of 61.8%. There's the 38.2% ratio. And then there's the 161.8%, which these sort of numbers, they're crucial in predicting market movement. So let's just really briefly talk about, how these ratios are calculated. So the first one here, and you're going to see this number come up a lot when you're studying technical analysis. It's 61.8%. So this is sort of known as this golden ratio, and it's derived by dividing a number in the sequence, this Fibonacci sequence, by the number that follows it. So if we want to just take the number 13, the next number up would be 21. So, you do 13 plus the previous number was 8. So 8 plus 13 is 21. So you would do 13 divided by 21 and you get the number 0.619. And if you do that again, and now we go 21, and the next number is going to be 34 because we do 21 plus the previous number of 13. So we do 21 now divided by 34. And what do you get? 0.618. So that is an important ratio within this sequence of numbers. And then another important one is 38.2. So this one is derived by dividing a number in the sequence by the number that is 2 places to the right. So as you move along the sequence, this ratio approaches this 38.2. So if we were to go 13 divided by 34, that's 2 more down in the cycle, we get 0.382. If we take 21 and then 2 more numbers down in the cycle is 55. So 21 divided by 55, we get 0.382 and so on. So that's an important ratio. And then the last one that we'll cover here is the 161.8%. So basically this is the inverse of that first golden ratio point, or 61.8, so 0.618. So it's calculated by dividing a number in the sequence by the number that precedes it. And as you progress along the sequence, the ratio approaches this 1.68. So again, 21 divided by 13. So again, it's the inverse of what we talked about in the beginning. That's 1.615. If we do 34 divided by the previous number 21, then we get 1.619 and so on. And we're going to approach this 1.618. So, why are these ratios and these numbers important in predicting market movements? Well, traders believe that these ratios can help identify potential reversal points and extension points in the market. So again, that first one we talked about, 61.8%, that's like the golden ratio, and it's thought to represent the point at which a correction in the market is likely to end. So if you read some textbooks, or again, you're following other things, you're studying other technical analysis, you'll notice that this number right around 62%, it's sort of like if there's a correction, that's sort of like the lowest that market correction is going to happen. The other one, 38.2%, that is again where the market might change direction, and it's just based on the fact that this has happened a lot throughout the history of various price action that's going on. And then the other one, 161.8% there, that ratio is used to identify potential target levels for price movement. So you might have a price, and then you might predict that the 1.618 number is where the stock might rise to, and many times that is where the stock moves to, that particular number. So these numbers are here because they come up a lot in trading. So in Elliott Wave Theory, these ratios, they're used to predict the length of the waves in the market trend. So again, that theory of, you've got 5 impulse waves up, and then 3 impulse three correction waves. Well, these ratios will help you forecast exactly where some of these waves and some of these corrections are occurring. So for example, in wave 3, it is often 1.618. So that ratio there, times the length of wave 1. And then wave 2 often retraces, 50% or 61.8% of that first wave. So when you know these ratios and you're plotting them out, you have a wave 1, you can, predict to, a relatively good probability that, we're going to have a pullback to about 50% of that rise, or up to 61.8% of that initial wave 1 rise. And then again, wave 4 often retraces 38.2% or 50% from the third wave. So if you've plotted this out and you're studying this, and you can see that you have what's clearly a wave 1 in the stock, and then you clearly have a wave 2, and you've gone up to wave 3, well, you can predict that you're going to pull back about 38.2% of that initial move into your wave 4. And again, that is the basic premise of, this theory, using these waves, these 5 impulses and 3 corrections with these ratios, these Fibonacci ratios. So again, key concepts here, you've got retracement levels, and then you've got extension levels. So the Fibonacci retracement levels, they help identify potential support and resistance levels where correcting, might end. So we talked about that 62% or 61.8%. That's like where the correction is likely to end. At the 50% level, it could end, and the 38.2%. So these are common correction ending levels. So you've got to rise up, and if a correction is coming, you can expect with a better degree of probability than just guessing that around 38.2%, you'll reverse back up, or the 50% or the 62%. And then extension levels. So these levels project potential future price targets, beyond the first sort of initial move. So important levels are like the 100% level, the 138.2% level, and then this 161.8% level. So you've got common retracement levels, significant psychological levels that are in there. That 50% one is a psychological level. You've got retracement, and then you've got common extension levels as well. So let's talk through some of these, so you can get hopefully get a crystal clear understanding of how these sort of go. So let's just talk through the math here, and then with some actual numbers, and then some of these levels, these retracement levels and whatnot, might make a little bit more sense. So in talking about these examples, I'm going to have the terms original move or initial move. So the original move that we're talking about here, or the initial move in this wave, so when we're discussing these retracements and extensions, refers to the beginning of the wave sequence. So we mentioned earlier that wave 1 is like when you're coming off a low and you're up and establishing potentially a new trend up. That's the beginning of wave 1. So when we say, we always relate these numbers to that initial first move, that initial move into wave 1. So that's like the initial impulse wave in this whole direction of this new trend. So talking about the 38.2 retracement, again, this ratio suggests that the stock is going to retrace 38.2% of the initial move before continuing the original direction. So say we have a stock that moves from $100 to $110. So it moves $10 in the first wave 1. Well, a 38.2 retracement would be calculated by basically taking the $10. So, 110 minus 100. So the initial move there is $10 times 38.2%. So times 0.382. And then you get $3.82. So the retracement level that you can predict here is going to be 110 minus 3.82, which is 106.18. So basically that tells you if you're trading this and you're using this strategy, you can see that wave one has gone up $10 from 100 to 110. You can expect the stock now to fall down to 106.18. It could retrace by 38.2% of that initial move. So the $10 move up is going to retrace now by 38.2%. So that is something that you can use for your trades. You can, get ready to buy at that point, or you can sell short to that point, and so on. So if we look at the 50% retracement, we would just do the calculation the exact same way. The 61.8 retracement along the same lines. And then for the extensions, common extensions are 100%. So that initial move is from $100 to 110. So it's $10 move. So we can expect 100% extension to be $10. So if it retraces to 105, then the extension is going to be $10 more. So 100% of that initial extension. So we would move from, say, $105 up to $115. So again, with that knowledge, you can make your trades around that. And again, these ratios, these Fibonacci numbers have created these ratios that are used and often are a part of this wave pattern. So the 138.2, so 138.2 extension, you can predict that number to you would times 138.2 by the initial move to, predict where the stock is going to go after a little pullback and so on. So those are the retracement numbers and the extension numbers. And basically that's just a quick little example of how they are used and how you would, have this math out there and how you would make these predictions. Now, in terms of, you might be wondering, okay, how are you going to do all this math in real time? So you have you notice a wave forming, and you want to kind of project these numbers. Well, in your charting tool, so we're going to be using TradingView, and I'll have a link below to TradingView. You can go and sign up with a free account. Basically, there will be a tool called a Fibonacci extension tool or a Fibonacci replacement tool. And basically, you would just plot this tool right on your chart wherever you want. And when you plot that on, and you can see the retracement prices. So if a stock's at a certain level and you want to see what the price is going to be at the 38.2% retracement, or at the 50% retracement, or at the 61.8% retracement, you can see that price level, and then you can put in your trades that correspond to that. And the extension levels as well. When you use this tool, you plot it near the bottom of wave 2 and you extend it up, and then you can do all your forecasting based on your knowledge of Elliott Wave Theory. So you can say, we expect, wave 3 to reach the 138.2 level, and you can figure out where that price is going to be. And that is where you can predict that the price is going to move off the correction wave 2 up to wave 3, and you'll have an idea of where you're forecasting the price. So it's all done on your charting tool. You don't need to actually do any of this math, any of these calculations, personally or in your head. It's all done on your charting tool. So I'm hoping that sort of makes sense, having this discussion here. I thought what I have here is sort of like a real-time example, and maybe I'll just talk through the first kind of wave, just so you can kind of get a better understanding of how it would work with a stock price. So let's just walk through sort of a hypothetical situation where, let's pretend we've got this stock and it's starting at $90 and it moves up to $100. And this is forming this first wave 1 in our, Elliott wave structure here. So analyzing this wave 1, what we're going to do is we're going to identify basically 5 waves within this first move up. So wave 1 of 1, basically, we can predict or just pretend that the stock moves from $90 up to 92. And basically that is the first little move up from 90 to 92. And that's sort of like the first leg of this 5 wave move, which is part of the full one, the first wave 1. So again, remember at the beginning, I said, 5 waves is going to be the main movement, but within each wave, you've got other waves. So if we're moving up, which we are in the first wave one, then we've got 5 other waves that move in that direction. So then wave 2 in this first impulse, wave 1 would be maybe a correction. So you might move from 92 down to 91. And then wave 3 of this first wave 1, you're going to move maybe from 91 up to 96. And then wave 4, you're going to move from 96 to 94. And then you're going to move from 94 to 100. So from 90 to 100, that's wave 1. And there are 5 waves that make up that first wave, 3 impulse waves, and wave 2 and 4, 2 correction waves. So if you study this, you can trade the whole way up, or you can just, trade from 90 to 100. You don't have to trade every single move, but you certainly can. So then you end up at wave 1, and it's been a net move of $10. So you've gone from 90 to 100. So then you have a big wave 2 correction. So we can expect that it's going to drop by 38.2% or 50% or 61.8%. So that's what we are going to sort of forecast. And then for this example, we can just assume that we retrace by 50%. So from 100, we're going to drop by $5. So it's going to be 50% of the $10 move. And that creates now the bottom of wave 2. Now, keep in mind, to get down there, we're going to be, having several other waves that actually get down to this bottom of base 2. So you don't directly go from 100 to 95. You're going to go down and up and down and up and so on. So below this video, I'm going to have an article that sort of lists all this out for you to read to get more understanding. But basically, we would move from 100 down to 95, and then you're on the bottom of wave 2, and now you're going to forecast that you are going to project up into wave 3, and you might be using the 13.82 projection, and that's going to project that the stock now is going to rise up to 108.2, and again, it's going to go up and down on its way up to that point. But if you're trading and you're using Elliott Wave Theory, then you can buy at 95 and maybe look to sell at 108. So that's basically the gist of it. And then that's wave 3. And then there's a correction wave 4. And then there's the final impulse wave 5. So I think I'll kind of stop there with that explanation. I would recommend that you check out the resource below. There's an article about this. And then if you sort of see a visual representation, or if you go on X and you watch the Tesla tracker, he's doing all this in real time with charts and good visuals. So I would certainly recommend that you check that out. And again, below in the show notes, I'll have an article where you can kind of read through this and you can get a better understanding of the 5 waves and then the waves sort of within the wave. So I understand if you're hearing this for the first time, maybe none of this is making sense. Maybe some of it is clicking. For me, reading a textbook about this was quite difficult to understand. But having visuals with the text, having the slideshow, just check out the resources in the show notes because it's going to help you understand this if you are interested in learning more about the Elliott Wave Theory. So sort of just to wrap up here, we'll just kind of have some a conclusion statement here. Basically, the Elliott Wave Theory, it offers this structured approach to understanding market movements based on the natural ebb and flow of investor psychology. So by dividing market movements into 5-wave impulse patterns, followed by 3-wave correction patterns, traders can anticipate future price actions and identify high probability trading opportunities. So there's a lot that goes on in here, but you are going to be able to get some high probability trade. So the integration of these Fibonacci tools, it enhances the predictive powers of Elliott Wave Theory. So by applying the Fibonacci retracement and extension levels that we went over, you as a trader can potentially pinpoint the support and resistance levels, helping you make informed trading decisions about when to exit or enter various trades. So we talked about those common retracement levels, 38.2%, 50%, 61.8%. Those are going to help identify when a correction may have ended. So for us beginners, And just kind of, if this is the first time you're hearing about Elliott Wave Theory, just remember that this theory provides sort of a framework, and it's going to take a while to master it. So monitoring the waves and using the Fibonacci levels, it's going to help you make educated predictions, but you will need some practice on it. You're going to need some other resources on it to really fully grasp exactly what is going on in terms of this whole thing. But basically, to summarize it, this theory, this wave theory, combined with these Fibonacci tools, it really does offer a powerful method for forecasting market movements. At least that is according to some traders that use it and use it successfully. From my personal experience, just watching someone for the last, 5 months or so doing this, I like this concept. I like this trading strategy, and I think it's going to be something that I am going to continue to use and potentially use in the future. But again, you're just going to have to decide if it's something that is going to fit into your trading toolbox. But remember, nothing's foolproof. The probabilities are high, but they're not always foolproof. And not every sort of wave movement is going to work out as you thought. So, I think we'll stop there. I hope that this was useful. I think it's a bit of a difficult subject matter to cover in one podcast. Hopefully this was a good introduction, and hopefully, this discussion helped you, or maybe, is pushing you towards maybe looking a little bit more into Elliott Wave Theory. Certainly if it's not, it's certainly not something you will need to use in your specific strategy if you don't want to. But for me personally, I think I am going to learn more about it. So thanks so much for listening. This episode, we talked about Elliott Wave Theory. What I think we're going to do for the next episode is I think we're going to do a recap of technical analysis and just talk about, everything that we've spoken about so far on this journey. And then I want to talk about a trading journal. And then we're basically going to do, the final episode of, this first series. We're getting close to the end of 6 months. So we want to wrap it up and kind of do a review of everything we've learned in the first 6 months, and then talk about what we're going to kind of cover in the next phase of this journey. So thanks so much for listening. All the resources you can find in the show notes. And I look forward to talking with you in the next episode and sort of wrapping up this first phase of this journey. So I will talk to you soon.